As you look at the data we're getting out of Europe, we're focused so much on Asia. Here, the U.S. economy, such a mixed picture. How do you see things?
Well, first of all, the biggest issue, I think, overhanging markets, at least if you're in New York, is the short-term and medium-term outlook for the U.S. economy, and the huge debate about whether we might have a recession or not have a recession. My own view is no, we're not going to have a recession. The U.S. economy remains, and has been for some time, solid, unexciting, but solid, growing in the vicinity of 2%. People forget that the export share of the U.S. economy is only approximately 15%. Therefore, global weakness has a limited effect on us. I personally think the only serious threat to the U.S. economy from the point of view of recession risk are the financial markets themselves, and whether a spurt of volatility and financial market weakness could frighten consumers and frighten businesses, and also generate a series of negative wealth effects. So my own view is the outlook for the U.S. is essentially fine. Europe, this data is really in keeping with the macro view one would have, which is Europe is barely moving up, in the vicinity of 1%. That's what you would expect, given how relatively recent the banking and sovereign debt crisis there was. Remember, it was only 2011, 2012, and the whole Rogoff thesis about how long it takes to come out from a banking crisis. So that's what you would expect. So I don't find any of this surprising. And Europe weakness is what we would expect to see if we were historians.
So it feels like we've had a pretty turbulent time, going back to August, right, where the markets went way down, then came back in the fall. Then at the beginning of this year, went way down, seemed to be coming back some. What is the significance of the fact of volatility itself, as opposed to the overall level at which the markets operate? Does it really affect the economy?
Well, the way it can affect the economy, we witnessed rather briefly last August and about 4 weeks ago, which is volatility spikes. It's typically inversely correlated to equity markets, for example. The higher the volatility, especially if it's spiking up, the lower the markets. If you were to have a sufficient spike and a sufficient market weakness on the other side, you could have the effects I talked about in terms of scaring consumers and businesses, and ultimately a negative wealth effect. That's the way that the VIX itself and all that it symbolizes could spill into the economy. We're not in that mode right this minute. VIX is back down, and markets have been strong. And the big question is, will we see a recurrence of the volatility of last August and 4 weeks ago? My own view is, yes, we probably will.
And you don't see an effect on U.S. consumer spending yet?
No, this is one of the things that I think too many people don't focus on. 2/3 of U.S. GDP is consumer spending. Most of the data on the consumer is encouraging. It's not discouraging. The most recent data on retail sales, on final consumer purchases and so forth, is solid. And you would expect that with gasoline prices as low as they are, wages beginning to move up, job creation rate being healthy. That's what you would expect. So the consumer is relatively solid. Any given piece of data can be a little out of that theme, but relatively solid. And therefore the U.S. economy, 2/3 of which is the consumer, is doing okay.
Roger, if you were on the Federal Reserve right now, you'd have a series of data and a series of upside surprises. Then you've got this concern internationally as well. But we've been told again and again and again that they're data dependent. Now, if they're data dependent, shouldn't they be hiking in March? If you were at the Fed, would you be voting for a hike?
Doesn't it depend on what data?
It does, but PCE, upside surprise, GDP, upside surprise, payrolls, still pretty solid. Okay. So both sides of the mandate tick.
Well, why don't we step way back for a minute?
Sure.
There are so many ironies in today's markets, and one of them is that if we fell down from Mars, we knew we had a lot of economic knowledge, nevertheless, we'd say to ourselves, let's see, historically, high oil prices, high interest rates, prospects of Fed tightening have been negative for growth and therefore negative for markets. So if we were beginning to see those indices moving that way, we'd be bearish. We're in a market now where, for the moment, the higher the oil price, the higher the open market interest rate, the greater the prospect of Fed tightening is bullish. Why? Because there's been so much fear, and because the absolute levels of oil prices and interest rates, for example, are so low by historical standards. But it's a historical irony that the way markets are responding is not in keeping with what you would expect over the long term. Now, the prospect for the Fed tightening, we've all seen what the futures are showing.
Yep.
That prospect is rising. If I were on the open market committee, first of all, I think the rest of the world would be terrified. But other than that, I think March might be too soon.
Yeah.
Just 4 weeks ago, we were looking at an abyss. A lot of us thought, at least. So I think March would be too soon. But the prospects for more Fed hikes in 2016, as compared to just the one we already saw, are rising now for understandable reasons, with the data improving.